In the old days of Basel regulation, we assumed every asset could be sold or hedged in exactly 10 days. The 2008 crisis proved that was a fantasy. Some markets dry up instantly, while others stay liquid for months. Under the Fundamental Review of the Trading Book, FRTB, the Basel Committee officially replaced that one-size-fits-all rule. Now we use liquidity horizons. This is defined as the time required to exit a position in stressed conditions without moving the market price. We now have 5 distinct categories: 10, 20, 40, 60, and 120 days. Large cap equities or major currencies? Those are category 1 with a 10-day horizon. But if you're dealing with credit spread volatility or small cap equity volatility, you're looking at 60 or even 120 days. Essentially, the less liquid the asset, the higher the capital charge. To account for these different horizons, we use a nested expected shortfall approach. The formula looks like a beast, but here is how you master it for the exam. First, we calculate ES1, which is a 10-day shock applied to all risk factors across all 5 categories. Then, we calculate ES2, but this time, we hold category 1 constant and only shock categories 2 through 5. We repeat this waterfall process all the way down. The square root of the differences, specifically the square root of open parenthesis LH sub j minus LH sub j minus 1, close parenthesis, over 10, is how we scale those 10-day shocks up to their assigned horizons. If you only have category 1 and category 2 assets, the math simplifies down to a much friendlier square root of ES1 squared plus ES2 squared. Just remember, the formula is designed to stack the risk of longer horizons on top of that base 10-day shock. Next, FRTB fixed a major loophole: regulatory arbitrage. In the past, banks would move assets into the banking book, where they are held at cost, to avoid the stricter mark-to-market capital rules of the trading book. FRTB puts a permanent roadblock in the way. To be in the trading book, a bank must prove more than just an intent to trade. They must meet strict criteria for physically managing the risks. Once an asset is assigned, it stays there. Reclassification is only allowed in extraordinary circumstances, like a firm-wide accounting change. And here's the kicker: even if you do move an asset, you are strictly forbidden from taking any capital benefit from the move. You must retain the higher capital requirement of the original method. No more gaming the system. If a bank wants to use its own internal models approach, IMA, it has to prove those models actually work through 2 high-stakes tests. Interestingly, we don't backtest the stressed ES itself. It's too extreme to test reliably. Instead, for backtesting, we use value at risk with a 1-day horizon at a 99% or 97.5% confidence level. But there's a second, harder test: profit and loss attribution, or PLA. This compares the model's predicted P&L against the actual P&L. If your model fails these tests on 4 or more occasions in a single year, regulators pull the plug. You lose your IMA status and are forced back to the standardized approach, which is almost always a much more expensive way to hold capital. Finally, let's look at credit. The old incremental risk charge is gone, replaced by the incremental default risk, or IDR charge. This captures jump to default risk for both debt and equities. To make sure banks are covered for the worst-case scenario, it's calculated at a massive 99.9% confidence level over a 1-year horizon. And for complex securitizations like ABS-S or CDOS, regulators decided internal models were just too inconsistent between different banks. So, under FRTB, all securitizations must now use the standardized approach. No exceptions. FRTB is a massive shift toward realism in risk management. It's complex, it's quantitative, and it's a huge part of your exam prep. If this breakdown helped you, make sure to like and subscribe. This is simply FRM, and I'll see you in the next one.